financial survival tips to navigate this high inflation. Good day, everybody. Chris Herline here of REAP Financial and host of Retire Ready TV on KXAN. Host of Wealth Radio every Saturday, 11 a.m. on News Radio KLBJ for over a decade now. Great to have you with me today. I want to dive into a few things, but before I do, be sure and hit the subscribe button. I drop new content here every Wednesday so you can stay on top of the latest. Now, it's no secret that inflation is higher than we've seen in the last 40 years. Here in 2024, inflation is still very high. And inflation was pretty much non-existent prior to COVID. We had decades where inflation was in the 2 and 3% range, in many cases even lower. So inflation has caught people by surprise. But those of you that are retired or soon to be, you've got to be aware of what you're dealing with here. Inflation will never make you broke. It'll make your lifestyle broke. So today I'm going to talk about financial survival tips to navigate this high inflation. And also be sure to tune in until the end because I'm going to show you how to take advantage of today's high inflation markets. So, what is inflation? Inflation is too much money chasing too few goods. Now, back in 2021, 2022, the government was handing out money. Well, they were printing money and handing out money. And we saw $4, $5, $6 trillion put into the M2 money supply. People were spending money. They were going on trips. They were buying things because they had excess cash. Now that cash has come back down to normal levels because most people have spent it. Through the pandemic, we saw shutdowns and that created supply chain issues. That has also been a big part of inflation. But the key to inflation is money being printed. And when you had that much money printed, 5-6 trillion, the M2 money supply, literally overnight, that's what's created this inflation storm. So as I've said at the top of the segment, inflation will never make you broke. It makes your lifestyle broke because it creeps up. And I can't tell you how many retirees that we consult with throughout the year, we're updating their planning, we're confirming that they need X amount of dollars for their budget and to maintain. And we've seen families easily increase $500 to $1,000 a month just over the last 4 years since COVID. True statement. I don't have to tell you this. You go to the grocery store, it's $100 for 2 bags of groceries if you're lucky. The thing about inflation is, yes, it's high. Will it come back down? Yes. In 2021, the Fed was saying that inflation was transient. It's temporary. Well, inflation has come down somewhat, but it's still well above the 3 and 4% target. They want the inflation at a 2% target. We're hovering above 4. So we still got a lot of work to do. And the Fed is going to have to keep interest rates high to be able to balance this inflation game out. But even when rates come down, even when inflation comes down, there's certain areas that we're not going to see a decrease. And unfortunately, it's in things like food and energy cost. Gas will always fluctuate. Your airline tickets will fluctuate. But when it comes to staples that all of us count on day in and day out, many of these items, we won't see prices go down. So as you're thinking through your retirement planning, you must factor for inflation through the years. That number you're putting in that is buying those goods and services today must go up year over year to account for the inevitable. I like to use a 100-year average. That's a really good starting point. You can't put 7% or 5% or even 3% in there for the whole duration of your retirement because that's not realistic. But adjusting it once a year based on a 100-year average, you're going to see the thing fluctuate up and down in a very sensible and conservative way. So when we're talking about your budget, what I'm really talking about here is your income plan. Generating enough income from your portfolio to sustain your lifestyle and everything you're wanting to go after in retirement. And so how does inflation impact your income plan? Well, it's not just that you're distributing money from these accounts, your income, your paycheck, but the money must be invested in a way that it's keeping up with inflation. Back in 2020, 2021, the Fed cut interest rates to literally zero. And if you had money at the bank, you had money in money markets or CDs, you were making little to nothing. We call it dead money. Well, one of the benefits of a high interest rate environment that we're in right now is that you can get much more competitive rates on safe money today than we've seen in over a decade. Money markets at 3 or 4. As a conservative investor, it's never been easier because you can get money markets and savings accounts that are paying 3, maybe 3.5%. You got CDs paying 5 to 6. You got MYGAs, multi-year guarantee annuities, paying 5 to 6. And so staying conservative, your money growing at 3, 4, 5% is exponentially more than you could get. But is that going to cut it? Because if inflation's running at 3 or 4% and you're getting 4 or 5, you're barely treading water. So your investments, your portfolio must be designed not just to generate income in a conservative way, but also to hedge against the rising outflow, the rising budget that you're going to experience over the years to come due to inflation. Hey, quick tip here, visit reapfinancial.com to download many of our retirement resources at no cost. That's reapfinancial.com, and be sure and leave your comments and questions below so that I can answer those in future videos. All right, so we're talking financial survival tips. We need to talk about how to inflation-proof your portfolio. The first way to go about it is to have a really proper investment mix. And we've all heard about diversification and all these type of things. It's really overused in the financial landscape, I know. But let me ask you this. In 2022, when the market was down 10 to 40%, whether you're in bonds or stocks, what in your portfolio went up? Most people, they say nothing. Nothing was really working except cash. That was the only thing really going up. Maybe real estate. That didn't lose a dime. Maybe CDs and multi-year guarantee annuities, indexed annuities. These are assets that actually didn't lose money. Do you have these things in your portfolio? You need zig and zag. You need to hedge, particularly in retirement, against principal loss. The stock market can knock you out quick, but the stock market can also keep your portfolio way ahead of inflation. So it's about finding that nice balance of risk and reward. But you need to have money that's working, going up, not going anywhere when the stock market's going down. So that's a real key, really the first key to hedging against inflation, protecting the money, the nest egg you have. Second is having a nice mix of assets that are going to grow conservatively, very steady. Then you've got more moderately aggressive, that maybe if this bottom falls out in the stock market, yeah, you lose a bit, but you don't have to go back to work. And then you've got your more aggressive investments, and this is the part that can really help hedge. Whether it's an S&P 500, any of the indices in the equity markets, if you've got opportunity to have 10 and 20% plus returns in a given year, that's the part of your portfolio that can really help keep you ahead of inflation. But we can't have everything there, right? Because we can't afford to lose a significant amount in retirement. There's also this known idea of what's called a withdrawal rate. What's the magic number? Well, the old days of retirement, back in the 90s, early 2000s, most advisors worked off of a 4% rule. And in our opinion, with inflation today and everything else, that's too high. We generally want to see you at a 1 or under a 1% withdrawal rate the first decade of retirement, because we don't want you taking too much money out of these accounts that need to be working for you too soon in these early days of retirement. So you need to monitor your withdrawal rate. Most of the successful retirees we retire Well, they're able to keep it under 1% for that first decade, and it makes a significant impact in the longevity of that portfolio. Now, in high interest rate environments, in high inflationary environments, is there a silver lining? I did touch on it today, but you need to be mindful of it. High interest rate environments mean that safe money, steady money, is paying higher and higher rates. Now, I think as of 2024, we're not going to see rates go all that much higher. I truly hope that's not the case. But the idea that rates are going to go back down to 2% next week is very unlikely. So I think for those of you that are more conservative or already retired, the days of safe and steady money, I think those are here to stay for some time. Now, when it comes to inflation and high interest rates, that can also make markets very volatile. We've seen volatility in the last 4 years since COVID. We've had good years, we've had tough years in the market. But is there silver lining in this market volatility that's caused by inflation? There is. When your portfolio drops 10, 20, 30%, it's not fun, I get it. But the silver lining is the potential that you could convert IRAs or 401ks to Roth IRAs, Roth 401ks at a significant discount. If you convert the shares in your IRA to a Roth when they're down 20%, when the market turns around, and historically it does, when that market turns around, everything that comes back and more is now yours forever tax-free. Or you can convert at all-time highs in the market. Obviously, you don't know when that is or what day that'll be, but if you convert it at all-time highs, and then 2 months later, the market drops, your portfolio drops 20%, you're gonna be going, gosh, I wish I waited. But we never know when the market's gonna fall, but when it does, are you in a position to take advantage of this silver lining that I'm talking about? These are the tips. These are the survival tricks to hedge against inflation that is likely here to stay. To learn more about retiring during this high inflationary period, be sure and watch Retiring Today in High Inflation Environments.